Imagine two investments that both own exactly the same 500 companies. Both grow at almost exactly the same rate. Both pay similar returns. Yet one can be bought in seconds during the trading day, whilst the other can only be bought after the market closes. One trades like a share, the other doesn't. So which one should beginners choose? Today I'll explain ETFs and index funds in the simplest way possible. And by the end of this video, you'll know exactly which one is right for you. The biggest misconception is that ETFs and index funds are competitors. They're not. An ETF is simply a way of buying an investment. An index fund describes what the investment actually owns. Think about it like this. Imagine you want to drink coffee. You can buy coffee in a mug or in a takeaway cup. Different containers, exactly the same coffee. Likewise, you can own an index through an ETF or through a traditional index fund. Many beginners compare them as though they're completely different investments. They're often investing in exactly the same companies. Before comparing them, we first need to understand what an index is. An index is simply a list of investments. The FTSE 100, pronounced FTSE 100, tracks the 100 largest companies listed in the UK. The S&P 500 tracks around 500 of America's largest companies. The MSCI World tracks companies from many developed countries. Nobody actually owns the index, it's just a benchmark. Funds are created to copy that benchmark. That's where ETFs and index funds come in. Now that's out of the way, let's compare them. Let's start with an index fund. An index fund is designed to copy an index as closely as possible. If the FTSE 100 rises 8%, the fund aims to rise close to 8%. If the S&P 500 falls, the fund falls too. Nobody's trying to beat the market, the fund simply follows it. This keeps costs low because expensive fund managers aren't constantly buying and selling investments. For decades, index funds have become one of the most popular investments in the world. Now, what is an ETF? ETF stands for Exchange Traded Fund. The important words there are exchange traded. That means you can buy the ETF on a stock exchange just like buying shares in any company. If markets are open, you can usually buy or sell immediately. Prices move up and down throughout the day. Many ETFs simply track an index. For example, an S&P 500 ETF owns companies such as Apple, Microsoft, Amazon, Nvidia, and hundreds more. Although you're buying one investment, you're instantly investing in hundreds of businesses. Now we reach the question everyone asks. What's actually different? First, how they're traded. ETFs trade throughout the day like shares. Traditional index funds usually buy and sell only once a day after the market has closed. Second, minimum investment. Many ETFs let you buy a single unit or even a fractional unit through some brokers. Some traditional funds may require a minimum investment. Third, automatic investing. Many index funds make monthly investing extremely easy, although today many brokers also allow automatic investing into ETFs. Fourth, pricing. ETF prices constantly change during market hours. Index funds have one price calculated each day. And then finally, costs. Both are extremely inexpensive, but always compare the ongoing charges before investing. Even small differences can make a big difference over decades. Okay, so which is better? Here's the interesting answer: neither. For long-term investors, the difference often matters far less than simply investing consistently. A low-cost S&P 500 ETF and a low-cost S&P 500 index fund are likely to produce very similar long-term returns. The biggest factor isn't whether you choose an ETF or an index fund, it's whether you stay invested. Many beginners spend weeks trying to choose between nearly identical investments while delaying making that investment. Time invested usually matters far more than tiny differences between these products. Now, let's clear up a few myths. Myth 1. ETFs are always riskier. False. Risk depends on what the ETF owns. A broad global ETF is generally very different from a leveraged cryptocurrency ETF. Myth 2. Index funds always outperform ETFs. Again, false. If both track the same index, performance will usually be extremely similar. Myth 3. You need lots of money. False. Many brokers allow investing with relatively small amounts. Myth 4. Passive investing means no risk. Definitely false. If markets fall, both ETFs and index funds can fall too. Diversification reduces risk. It never removes it completely. So let's recap. An index is simply a list of investments. An index fund copies that list. An ETF is simply a way of buying a fund on the stock market. Many ETFs are index funds, but many index funds are not ETFs. For most beginners, choosing a low-cost, diversified investment and continuing to invest regularly is far, far more important than worrying about a label. Successful investing usually comes from patience, consistency, and letting time work for you. If you found this guide helpful, please like, subscribe, and leave a comment telling us whether you prefer ETFs or traditional index funds. Every question and comment helps shape future videos. Thank you for watching, and I look forward to seeing you on the next video.